you and then go back to sharing. Okay. Okay. So we're going to meet. I'm going to be online every Wednesday night at 6 p.m. So if you've got questions on that week's materials, or especially when we get close to the midterm exam, the due date for that, which I'll go over here shortly, you know, you'll have an opportunity to come online and send me your problem. I'll go over it. We'll review it together and go from there. So the scores, the textbook is here. It's the 13th edition by Hoyle. Highly recommend buying the book. I know some students try to save a little money, not buy the book. This is an older edition. They've got a 14th edition that we're probably going to have to adopt come fall. But you should be able to find this used online pretty reasonably. So we've got a midterm test that is going to really be the focus of the first 5 weeks of the course. And I'll explain that and introduce that. I'll be emailing you your version of the midterm test between now and next Wednesday. But I will pull it up here later this evening and show you what we're expecting you to do. Then there's a score on a final exam. The final exam is not cumulative. It's 3 chapters, the last 3 chapters that we'll be covering. There are online quizzes on Blackboard, which I'm going to go through the Blackboard site here shortly, that are going to make up 20% of your grade. 10% is going to be participation, which is, you know, basically tonight, and then all of you will get that 10%. And then lastly, there's an Excel certification exam, which I'm hoping over the next 8 weeks, they're going to open back up the examination site. It's on 410 and Vance Jackson. And right now it's closed. So I do have a Microsoft Office Specialist Excel voucher for you and a study program that you can go on, and it simulates the Microsoft Office exam, the basic exam, and to help you pass that. And if you do pass that, then you will be Microsoft Office certified, which is something I highly recommend you put on your resumes. It's something that employers do look for. So hopefully that opens up. If not, then you'll have that voucher. They're good until December, and you can take it for your own personal reasons. It's anytime in the fall when they do open it up. But I'm optimistic that they're going to open up sometime here in later in June or July. So I'll let you know on that. But I'll be sending those vouchers and the access keys to the study program out this week also. All right, so the schedule is going to be tonight. I'm going to introduce Chapter 1, Equity Method of Accounting for Investments. Then next week, I have recorded 2 separate videos, which I'm going to show you on Blackboard here shortly. 2 separate videos per class, one on the PowerPoint introducing it. Both videos are about 10 to 15 minutes long. And then a second video of me solving problems out of the back of the chapter in Excel. So those are going to be on the initial consolidation of financial information. That is, how does a consolidated financial statement look immediately after the acquisition of a wholly owned subsidiary? So going out and buying 100% of another company and then on that date of acquisition, going through and doing what is known as the consolidated worksheet. And so we're gonna, that is explained in the videos in Chapter 2. Chapter 3 is subsequent to the date of acquisition. So now you own this other subsidiary. You've made the decision to maintain it as a separate legal entity with its own books. And so it's going to start earning income and have its own balance sheet. So what do you do at the end of the first year of operations or the second year of the third year? So that's the basis of Chapter 3. And then Chapter 4 is what is the last piece that you need in order to do the take-home exam. And that is outside ownership. So what do we have to do as accountants to account for minority ownership? So we don't buy 100% of a target subsidiary. And so what do we do in adjustments to our worksheet in order to account for this minority owners? And then that will be the basis. The first Wednesday in July will be just a work session. That will be, if you haven't finished your midterm by then, it will be your opportunity to come online, email me your worksheet as it's in its current format, and then I'll share my screen, pull up your worksheet, and go through and give you review notes on what is right and what is wrong. And then by midnight that following Friday, oh, that says June. Oh, let's see here. What is the actual date? So that will be July 3rd, not June. Let's change that. I'll repost this onto Blackboard here shortly. So Friday, July 3rd will be the due date for the midterm exam. And I'll make sure that online that is in fact the due date on the Blackboard. Okay. So then when we get finished with the midterm, we've got 2 weeks of Chapter 8, which whenever I'm lecturing Chapter 8 online in the classroom, I always say it's the easiest chapter in accounting that you will have ever had. It's on segment reporting. And once again, there's 2 videos of me lecturing and solving problems. And then the last one is the last week, the 15th of July, is Chapter 8, 9, and 10. And that's on foreign currency transactions and translations. So transactions are you buying and selling goods and services with a foreign customer or supplier, and how do you account for that? And then translation is that you own a foreign subsidiary. And so how do we consolidate a company whose books in their home country are in a currency other than US dollars? And then as soon as we finish up with that last week, that following Friday, I will open up the midterm. It will be open up until midnight of the following Wednesday, the 22nd of July. And so you'll have plenty of time to go through and be able to solve that. And like I said, it's a take-home, 3 problems. You'll do it in Excel. You'll pull up an Excel template. Actually, I'm going to supply you an Excel template that has a worksheet for Chapter 10, and you can just add some tabs to that in order to do Chapter 8 and Chapter 9 problem. All right, so that is the course outline. Let's go from there to, oops, oh, I shut down the shared. Let's go back to the shared. and go to here. I meant to just close down the file, the syllabus. Okay, when you enter in the Blackboard website, it defaults here to chapters, and I'll use chapter 2 as an example. When you click on that, it has two things going on. One, it's got lecture recordings of, this is Professor Pittman lecturing this course so the materials in chapter 2, for instance. There is your online quiz. There is unlimited attempts on the online quiz, so you can take that as often as you want. And then, isn't that interesting? It doesn't have my lectures. Let me look at chapter 3. Yeah. Okay, I'll figure out why chapter 2. Actually, I know why, because chapter 2, I'll record that between now and next week. Chapter 2 was a live presentation in the spring when we came back from spring break. I started with chapter 2 and I did that live like we're doing tonight. So, but I'll go on and record the PowerPoints and do problems in chapter 2. And you'll see them down at the bottom. So these are the two chapters, problem 28 and problem 30. And they're video recordings posted on YouTube that you can access and look. So chapter 4, this one is especially important because this has the last of the key material. So here's the problems associated with chapter 4. All right, so that's the Blackboard site. It has all the information you need. It also has the midterm exam submission, and I'll just check that to make sure that I have that as a due date. No, I don't. This is July 3rd at midnight. And we'll display it until July 3rd. I don't know where I got the June 19th thing from, but that's now updated. And then there is a review for the final exam with 3 similar problems to the actual final. And then the final exam will have 3 questions that are in PDF, and then there is a template for you to download and be able to answer that PDF. Let's see, summer. Yeah, Vivian, the question is summer term 1 is that this isn't in summer term 1. This is summer term extended. So we don't teach the graduate classes over the 5 weeks, summer 1 or summer 2. We do it over the 10-week summer extended. So that's not applicable. So. Okay, any questions on the Blackboard site? Okay, let me go ahead and pull up. Man, I keep stopping the sharing, which is not what I want to do. Okay. Let me go ahead and pull up the midterm problem. And I'll go over that. And like I said, you will each get a midterm for yourself. Where is it? There we go. Okay. Let me hide this real quick. All right, what you're going to be given is this information sheet. You're going to get your own version of this. And so yours is going to say something along these lines. The numbers are going to be different. They're all going to be 75%. So on January 1, 2018, you bought 75% in Bubba. You paid that for X amount of cash and X number of shares of common stock. At the time of the equation, the book value was X. At January 1, the stock had a market value of $25.85. That's all going to be the same. And then there are 3 assets where the book value is different than the fair market value at the date of the acquisition. So you're also going to be given a worksheet that looks like this with the year end. So this is the end of the year, the first year, the end of the year at the oh, you're not seeing this? Hold on. Let me go back to share. And I want to share that. Are you seeing a midterm problem now? Yes. Okay. Sorry about that. All right. Let me go back to the given. So you're going to be given a sheet like this where the numbers as far as the cash, the number of shares, the book value, and then the book value of land and building are all going to be your own numbers. They're going to be different numbers than what is in this example. So you're going to be given that plus a worksheet, which is the year end at the end of the first year after acquisition, trial balances for both the parent, which is John Doe, and the subsidiary, Bubba. And it will list the revenue and expenses, the equity income of Bubba, the statement of retained earnings, and then the assets and liabilities and stockholders' equity. So what you're going to be doing is we're going to be introducing over the next couple of weeks something called the SADE entries, which is subsidiary stockholders' equity is the S. The A is assets with differing book value than fair value. The D is dividends. The I is subsidiary income, the equity income. And then the E is expenses for excess depreciation and or amortization to account for those assets that had a different book value than fair market value. All right, so you're going to get this in a PDF, and I'm going to send this out between now and next week. And then every week as we go through chapters 2, 3, and 4, you'll get further insight on how to solve this. And then as we get closer, the first thing you should be able to do is solve for the goodwill calculation. And I highly suggest that you look at a chapter 4 video for that in order to give yourself the calculation on how to calculate goodwill when you're not buying 100% of the company. All right, so that is what the first step is, calculating the goodwill. And then you'll be able to go through and I'll explain how to do the 5 entries that are necessary in order to come up with the consolidated totals, as well as what to do with this H column here, non-controlling interest. So you're going to have 5 entries into this. You're going to have the non-controlling interest in Bubba's income. So you're going to have an entry here in H13. You're going to have an entry here in H18 for the non-controlling interest portion of dividends. And then down here in the stockholders' equity section in H32 and 33, you will have a non-controlling for the S in the A entry. And so that will become apparent once we get to Chapter 4 and successfully finish that. So that's going to be the the midterm problem. And like I said, I will be sending out your version sometime this next week. Okay. Let's see here. I want to save that. Okay. Let's do the PowerPoint slides. Any questions about any of this that we've done so far? I'm keeping the chat window open here in my extra. So if you've got a question, just go ahead and type it out in there, and I'll address it as we go through. All right, so Chapter 1 is reporting of investments in corporate entity securities. So this is a purchase of another company's stock, and how do we account for that? Well, there are 4 methods, 3 of which we'll focus on, and that is the fair value method. Depending upon the level of influence that we, the parent company, can exert on the subsidiary. So there's fair value, there is the equity method, and then lastly, there is consolidation of financial statements. So these come out starting with the fair value. This is us buying a very small percentage. The bright line in US GAAP is 20%. So if we buy less than 20% of another entity's stock, then we account for it in fair value method. If you recall back to your intermediate accounting, when you took intermediate accounting, there were 2 ways of doing this, depending upon management's intent. So depending upon whether management intended on keeping this stock for purposes of as an investment to hold on to, or if management's intent was to sell it, you accounted for it as either a trading security or a available for sale security. And if it was an available for sale security, then unrealized gains on the shares of stock went to other comprehensive income. They did not go to the income statement. If it was a trading security, in other words, management's intent when they bought this stock was to hold on to it for purposes of making a gain on the trade of stock. So selling it sometime in the near future. Then the unrealized gains, so in other words, an unrealized gain is, let's say you buy a stock for $25 per share. At year end, you revalue that stock to its fair market value. That's why it's called the fair value method. You then need to write that, let's say the stock at that date is trading at $26 a share, and you bought 10,000 shares. So you have a $10,000 unrealized gain in order to take your investment account from the $25,000 that you originally spent to buy those 1,000 shares up to $26,000, which is its current worth on your balance sheet. So you write that up. If it's a trading security under the old method, then that income, that unrealized gain on trading securities, went to the income statement. If it's an available for sale security, then it went to other comprehensive income in the stockholders' equity section. The good news is the FASB finally realized the absurdity of all of this, with management intent being the basis on what you did or did not do. And so they got rid of the available for sale securities. So now everything is just a trading security. All unrealized gains go to the income statement, and dividends, as they're declared, are dividend income. All right, so the fair value method is you record it at cost, you readjust it to its current fair market value at every balance sheet date, and you take the gains and losses to the income statement. So that bright line is less than 20%. But more importantly, the investor cannot significantly affect the investee's operation. All right, so recorded at cost, changes in fair value is recognized as income, and the available for sale security is no longer available as of for reporting years past December 15th, 2017. All right, so that one's gone. So that's the low end. That's buying less than 20%. If you buy more than 50%, then you need to consolidate. And that's going to be the basis of our chapters 2, 3, and 4. So any ownership in excess of 50% under US GAAP requires consolidation and the preparation of a single financial statement covering the entire entity, all of the holdings in the consolidation. And then in between there, in between that 20% and 50% is the equity method. So under the equity method, dividends are decreases in the investment account. So you would have an investment in XYZ company listed under your investment section of your classified balance sheet. Dividends reduce that investment account. At the year end, at your reporting date, you then take your pro rata share of the investee's income as your income, and you report it as equity income in XYZ company. And that increases the investment account. So every year there are 2 entries made under the equity method for each of the investments that you have made in excess of 20% but less than 50%. So you're going to debit dividend receivable on the declaration date and credit the investment account, lowering the investment account for the dividends that you're going to receive. And then you're going to debit the investment account, and I'm going to do some problems on this. You're going to debit the investment account and then credit equity interest in XYZ company for your pro rata share of the dividends, of the income. All right. So equity method can be applied if it's less than 20% if you are exercising significant influence. So what is significant influence? You get a seat at the investee's board of directors. You participate in their policy making in establishing long-term goals. You have significant inter-entity transactions between the parent and the subsidiary. So all of these items can be interpreted as reflecting significant influence. So here's our three percentages. Less than 20%, it's fair value. You record dividend as dividend income. You adjust the value of the stock at the balance sheet date and take the unrealized gain to the income statement. Between 20 and 50%, it's the equity method. Dividends are a decrease of the investment account, and then your pro rata share of their subsidiary's income is an increase to the investment account. And then more than 50%, those two entries on the parent's books are still done. Even if you own 100%, you still decrease the investment account for dividends and increase it for your pro rata share. But we will be eliminating those two entries in our consolidation worksheet through the SADI entries. Okay? All right. So we talked about this. We increase the investment account as they report income. And so that's equity method. They decrease for dividends that are declared. So the carrying value of the share of investees' dividends. So a quick example is that we buy a 20% interest in little company for $200,000. They then report net income of $250,000, $300,000, and $400,000 in the subsequent 3 years, and then also declaring dividends of $50,000, $100,000, and $200,000. All right. So this is equity method because we've got 20%, so that's the line, and so we're going to be decreasing the investment account by the dividends and increasing it by our pro rata share of the income. All right. So there's the income that is recognized, the dividends that decreases the investment account. So this is the carrying value at the end of 2017. So we report for our 20%. So we originally bought it for $200,000. We decreased that $200,000 by the dividends when they were declared, bringing the investment account down to $190,000. And then we increased it by $50,000, which is our pro rata share of the $200,000 of the equity income. And that brings us to a total investment account balance at the end of 2017 of $240,000. These are the investment account entries that are done at the parent company. So we accrue the $50,000, we do the dividend receivable, and then we receive the cash when the dividend is paid. So these are the 2017. All right. Oftentimes we purchase a subsidiary for greater than the book value of the subsidiary. So when we do that, we create an intangible asset called goodwill. So in each case, you're going to take the purchase price, and when we get to Chapter 4, that purchase price needs to be grossed up to 100%. So if we're buying, like in your midterm example, 75% of the subsidiary for X price, once you get your cash and the total value of your stock that you're exchanging, add that together, that's the purchase price. You then need to come up with the implied purchase price, which is what would it have cost you if you wanted to buy 100% of that. And I'll do an example of that here shortly, just to introduce it. I review it in detail in Chapter 4. You'll get an excess. You compare the total purchase price to the book value, which is at 100%, and you get an excess of purchase price over book value. You then subtract any specifically identified assets or liabilities that have a difference between book value and fair market value. Then once you account for those specifically identified assets. The difference that falls out the bottom from the excess is goodwill. All right, so here we're going to buy 30% of the outstanding shares of Chico Company. They have a net book value of $200,000, but we have equipment that is undervalued by $60,000 and a patent is undervalued by $40,000. So we offer $90,000 for the purchase price. That's the purchase price of 30%. If you divide 90,000 by the 30%, you get a total of 300,000 for the value. So 300,000 is the implied purchase price. 200,000 is the book value. That gives you 100,000 excess purchase price over book value. We have two assets, 60,000 in equipment and 40,000 in a patent. That eats up the 100,000 excess, zero goodwill in this particular example. All right, so there is no goodwill. And here's the calculation. So there's the payment and the calculation. And then you amortize the equipment over its remaining 10-year life at $1,800 per year, and the patent over 5-year life for $2,400 in amortization, for a total of $4,200 and this would be the basis of a E entry in the consolidated worksheet. So you adjust that by the 4,200, you reduce the equity and investee income, and you decrease the investment account by that excess depreciation and amortization. Okay. All right. What happens? You were in the 20%. You were to say you bought 40% of a company, so you were accounting for it under the equity method, but then you turned around and you sold 25% of it. So now you're in the fair value. It used to be that you had to retroactively go back and account for that. That also, the FASB changed here in the last 5 years. You no longer have to do that. So you just start from the balance sheet date, the next balance sheet date, and then adjust the investment account to its current fair value, and then start reporting dividends as dividend income. So that's the sale of an equity. And then the last thing that I want to cover is the sale of inter-entity transactions. So a downstream, which is the parent company selling to the subsidiary, or an upstream where the subsidiary sells to the investor. Now, this is a prime example of income that can be ginned up at year end, because you influence, you control this investee if you own more than 20%, and especially if you own 100% of it, let's say. So you're not allowed to report the gross profit from inter-entity sales until such time that that inventory is sold to an unrelated third party. So until you can sell it outside of the consolidated group, you cannot take the gross profit on it. All right. So it's delayed until you dispose of the goods. And that's primarily to address abuses in the past. We don't want to artificially inflate sales by moving inventory from a parent's warehouse over to a subsidiary's warehouse. The inventory is still owned by the consolidated group. Nobody bought it. So this was a prime example of some abuse in the past. So let's assume that we make 30% gross profit on a $10,000 sale. So we have a $3,000 gross profit associated with 10,000 in sales. 40% is what we own. So 1,200 of that is going to be deferred until such time that that $10,000 worth of inventory is sold to an unrelated third party, which they do in the following year. So we would debit the entity equity income and credit the investment account, removing the 30% gross profit of $1,200 in 2018, and then reverse that entry in 2019 when we dispose of that stock. So here's the investment account. We reduce the equity and investee income, and then that following year we get to take it. So we increase the equity, the investment account, and take the gross profit then. All right. Same with an upstream sale. So if you sell it from the subsidiary to the parent, you've still got to remove it from the consolidated total. All right, so that's it for the PowerPoints. Let's see here. Shut that down. All right, I'm going to finish up the lecture tonight with a couple of problems out of the back of the book. And so let me, so Ivy never made it to our class. So let me save this. Okay, I'm going to turn this light on, which will make me fade out a little bit, but can't read the book otherwise. So we're going to start with problem number 15 on page 30. So problem 15 on page 30. All right, on this one, it says on January 1, 2017, Ridge Road Company acquired 20% of the voting shares of Sauk Trail for $2,700,000 in cash. They both provide commercial internet support services, but serve different markets in different industries. They made the investment in order to gain access to their board of directors and facilitate future cooperative agreements between the two firms. They quickly obtained several seats on the Sauk Trail's board, which gave it the ability to exercise significant influence. So on January 1, on the acquisition date, we had various accounts, cash, $110,000, and that was the fair value. We had $5,000 in computing equipment that had a fair market value of $5.7 million. We had patented technology with a carrying value of $100,000, but a fair value of $4 million, and a trademark with a fair value of $150,000. Total value of $2 million. So in its entirety, let me go ahead and just quickly put that in here. Cash, computer, patent, mark, and the liabilities. Okay, so we've got 110,000, 5 million, 100,000, oops, 150, and 185. Oops. That's book value. Fair market value on each of these is this one is the same as is the liability. This one is 5,000,007. This one is 4 million. And this one is 2 million. A difference. No. There we go. Okay, so we're going to the acquisition price. Was 2,000,007. We have a total book value for the subsidiary is this 5,175,000 times 20%. That gives us an excess of purchase price over book value of 1,665,000. We then have the computers, which is this times the 20%. Those three. So this minus the sum of the excess gives us goodwill of 375,000. All right, so this one is that. All right, so that's the current. And then we're going to amortize these by 7 years. This is years. 7 years, 3 years, and the trademark is indefinite. So this divided by 7 is 20,000 and then 260. All right, so at the end of the first year, there is net income of 1,800,000 and dividends were declared of 150,000. And then what we'll do is we'll keep a investment in SAUK, in SAUK. So the investment started out at 2,000,007. We have 2017 income. Which is 1,000,008 times the 20%. So we would add that, and then 2017 dividend is 150,000 times the 20%, and that is a negative adjustment. So the investment in Salk at the end of 2017 is oh, hold on. We have the income, but we also have this minus. So that's the income at the subsidiary, but we have to subtract the sum of the depreciation and the patent. So the total is going to be, and what those entries are is going to be a debit to the investment account for the 360. Then we would lower that and decrease the investment account for the and lower it for the dividend. So those would be the three entries that would be made for the investment in Salk under the equity method. And then in 2018, we had $1,985,000. For $397,000. We would still have the same two entries for the amortization, and then dividends that year were $160,000. So 2018 income would have been this minus this, and then 2018 dividends would have been that. And so the investment account at the end of 2018 would have been $2,835,000. So that's how you equity account for entries in a subsidiary. That's when you own more than 20%. All right, let's do problem number 20 next. And that will be an upstream. So buys company holds 25% of the outstanding shares of Marqueen Company and appropriately applies the equity method of accounting. There is excess cost of amortization related to a patent that amounts to $10,000 per year. They report earnings of $100,000 and cash dividends of $30,000. During that year, Marquee the subsidiary, acquired inventory for $50,000, which it then sold to its parent company for $80,000. So it made $30,000 gross profit. At the end of that year, they continued to hold merchandise with a transfer price of $32,000. So this one is problem 15, page 30. Let's open up a new one. And this one is going to be problem 20 on page 31. Make this all comma, 0, negative. Okay, the first thing we want to do is calculate how much deferred inter-entity gross profit do we have. So we have remaining inventory of 32,000. There is a gross profit percentage of, we sold it for 80,000, but we bought it for 50,000, and divide that by 80,000. And that is a percentage of 37.5%. So the amount of deferral is profit in the remaining inventory is 12,000. Our ownership we own 25%. Which gives us a deferral gross profit. So in total, we have equity of $100,000 times 25%. We then will defer the intercompany gross profit That's the 3,000. And then we're going to subtract the 10,000 for the patent amortization. And that gives us a total of 12,000. Our ownership percentage of that is 25%. And this is the amount that we are going to, I'm sorry, no, hold on. This is our equity in investing income. All right, so that's what we would report on our income statement. And that should do it. I'm going to save this and post it online along with this video, and so that you can go back and review problem 15 and 20. So one is the equity method of accounting, and then the other one is the deferral of an inter-entity gross profit. So let me stop my sharing, turn off my lights so that you can see me, and end the recording. Let's see here. Oh, how I got the profit. Okay, hold on, Rebecca. I will go over that. So the question is how did I get the profit on the remaining inventory? So of the 80,000 that we bought, we have 32,000 left that has not been sold to an unrelated third party. We made 30,000 on $50,000 on an $80,000 sale because the inventory cost us 50,000. So 30,000 divided by 50,000 by 80,000 gives us a 37.5% gross profit percentage. So that means of that remaining 32,000 in inventory, there is 12,000 in profit. We own 25% of that. So we need to defer $3,000 because of inter-entity sales. Did that answer your question, Rebecca? Give me a thumbs up or something like that. Oh, I'm sorry, I wasn't. Do you want me to share the screen again so that I can look at that? Let me do that. Here we go. Okay, so we had 32,000 in total. That's this here. We made gross profit of 37.5%. That's the gross profit of 30,000 on a sale of 80. So 30,003 divided by 8. That means multiply that by the 32,000. We have 12,000 in profit, of which we own 25% of that. So 3,000 is the deferral in inter-entity gross profit. Okay. So let me stop sharing again. Did that work for you, Rebecca? Got it? Okay. All right, so let me end the recording. Like I said, I will